Welcome to today's class. Earlier we did divisional performance measurement and then transfer pricing. So now we're going to do the questions for both the topics. First, here's a question on divisional performance measurement and the two performance measures that are used to assess the manager as well as the divisional performance, which are ROI and residual income. I told you the advantages and disadvantages of using both the measures in our earlier discussion. Let's start with this question, sports scope. So before going through the exhibits of the question, I just want you guys to go through the requirements of the question first and understand the requirement. So this particular requirement is for 6 marks. So just first we're going to allocate the time as per 1.5 minutes per 1 mark. So for 6 marks, you almost have 9 minutes for that, and same 9 minutes for this part, and 1.5 into 4. You almost have 6 minutes for this part and 1.5 into 4. 6 minutes again, and in total, how much time do you have to do all these parts? Almost 30 minutes, and 6 minutes you're going to spare on to the reading and planning time. It's really important that you give your time, you allocate your time for the reading and the planning. Then only you will know what you have to do, okay? Rather what you want to do, okay? You may do wrong, you may overwrite, you may not write the right way. So it's better to understand what you have write before start writing. So just keep that chunk of the time for reading the scenario, reading the requirements, understanding the requirements, breaking into the verbs and action verbs and the objects, okay, what you have to discuss, which is the center of your action as your object. So in part A, you have to calculate the return on investment for each of the 2 divisions of sports scope. Okay, well enough. Okay, we're going to discuss about the marking scheme as well. There's 6 marks allocated. Okay. So, and then discuss the performance of the 2 divisions for the year, including the main reasons why their ROI results differ from each other, okay? So here you have to discuss the performance of the 2 divisions. The action verb is discuss. Discuss what? The performance. You have to discuss the performance, okay? And you also have to tell any main reason why the results were different from each other, okay? This is one part of the requirement. And the other part is another action verb here, which is explain, and more objects attached to that action verb. So it's explain the impact. Explain is the action verb, okay? You have to explain, okay? You don't have to state. You have to explain with examples, okay? With a little discussion, okay? Explain the impact the difference in ROI could have on the behavior of the manager of the worst performing division. So if I'm going to break the requirements, it's basically a 2-part requirement. At first, we have to calculate the ROI for both divisions, okay? It's part A. It wasn't very complex, okay? It was a straightaway requirement. But here we needed to calculate, do some working. So for part 2, here you have to discuss, okay? So first action verb is discuss. What you have to discuss, the performance of the 2 divisions. That's the object. Okay, what needs to be done? That's the action verb, and that's the object. We need to discuss the performance, including, and what else to discuss? 2 things to discuss. Performance and the main reason why the results were different. And in the other part of the requirement, you need to explain. The action verb is explain the impact the difference in ROI could have on the behavior. You need to discuss about the impact of the difference, the behaviors of the manager. So that about the requirement. Then you have to calculate the residual income and also comment. In part B, you have to calculate as well as calculate, as well as another action verb is you need to comment at the same time, but briefly, on the results of the performance measures. What does it tell you about the two divisions it's supposed to? And then in part B, you have to explain the advantages and disadvantages of using residual income to measure divisional performance. Explain is the action verb. It doesn't say state or outline or something like that. You would just go very straightforward. You will just highlight the important points. But here you need to explain. Explain the advantages and disadvantages of using residual income to measure divisional performance. Here you need to explain the advantages as well as the disadvantages of using residual income. And you need to explain here. For example, one of the advantages of residual income is that it avoids dysfunctional decision making. Okay. Did you understand? Did I explain well? No. Why? Why does it avoid dysfunctional decision making? And then I say it is more linked with shareholder value addition. Did I explain well? No, you know nothing about it. So we're going to discuss it, how you're going to write it. And writing the bullet points, okay, I saw a script of the student writing, it wrote all of the points in the bullet points. Okay, here it goes, the advantages, and then he goes for the disadvantages. Okay, though he wrote the right way, but those were the very to the point precise bullet points, and it wasn't explaining the idea as to why or because. Okay, that's how you explain. And he got 1 out of 4. So in the same way, if you're if you're not going to go in the paragraphs and then you're not going to explain it well, okay, even you have made your points and the points are right, but you're going to get something like that. So you need to know, you would rather choose to write in the form of paragraphs, okay? How do you make it a paragraph? It avoids dysfunctional decision making because, and here I go, I'm writing. It's not a bullet point thing. It's more like a paragraph that I'm writing, and that's explaining at the same time. It is more linked with shareholder investment because you deduct a notional charge. Yeah, here I go like this. So managers are more aware about the cost of investment, and they don't do wasteful spending. And also, if your project is giving a positive residual income, that means your earning from your project is above the minimum shareholder return. So it is more linked with shareholder investment, value addition. Okay. So that's how I explain it to you. And it avoids dysfunctional decision making because on the basis of the ROI, if investment increases, ROI decreases. And if managers' bonus is at stake by accepting a new investment, he won't be able to get the bonus. He will just reject. If any of the investment decreases his ROI, centers ROI, then the target ROI, then definitely is not going to accept the decision, though it earns the minimum shareholder return and the return on investment is greater than the cost of capital. Still, he's not going to accept the decision, and that's what dysfunctional decision making is. So you have to explain in the paragraph. If you're going to just write it down and not explaining well and going in the bullet points, you would get somewhere like this. Okay, so that makes the difference of failing at 48 and 47. Yeah, these are the points that you need to keep in mind. Not understanding the requirements, not breaking the requirements into action verb and the objects, and not writing what you should write and how you should write. this would earn you marks. That makes the difference. So now let's go to the exhibit of the question and do our requirement. Number one, that we have to calculate the ROI of both the divisions, and then we're going to discuss about the performance based upon the ROI and what is the main difference of the performance, how the two divisions have different performance results based upon ROI. What are the reasons for that? We're going to identify first the performance and then the main reasons. Let's first calculate the ROI for both the divisions, the two divisions, Division C and Division E of Sportsco company. Sportsco is a large manufacturing company, specializes in the manufacturing of wide range of equipment. Okay, so it's making the equipment, so definitely it has got the asset base. Okay, so the company has two divisions, the clothing division and equipment division, denoted by C and E, each with little intervention from head office, and divisional managers have autonomy to make their own decisions. So that's pretty much in spirit with the definition of the divisions. A division is where the managers have got the autonomy to take their own decisions. Okay. So, but at times there are certain assets they couldn't control and certain costs they couldn't control. So that we're going to look at. Sportsco measures the performance of the divisions using the return on investment. Okay. When you have to measure the performance of the division, you definitely use a relative measure, which is ROI. Okay, and you have to calculate profit on the base. You have to calculate a controllable profit, and on the basis of the average divisional net assets. Okay, the target ROI for each of the division is 18%. Okay, we have to look at what is their ROI and whether they meet this target ROI. That we're going to look at in part B, where we have to discuss about their performance. If they meet this target ROI, that means that particular division is performing well, have achieved their target. And managers only get bonus if the division's target is achieved, then only they get the bonus. Okay, so here we are, it's good when we're measuring the performance of the division on the basis of the ROI, it's good. But here we are also assessing managers' performance on the basis of the ROI, which is not a good thing. Okay, if managers' bonuses would be at stake, they would not accept. They would not accept a new investment, because with the increase in the new investment, when their performance is assessed on the basis of the ROI, when investment increases, ROI decreases. So it might be they might not achieve the target ROI and they don't get bonus. So definitely they would go for the dysfunctional decision making, which is basically the disadvantage of using ROI when assessing the manager's performance. So they definitely would go against the spirit of goal congruence, and they would be tempted not to accept the profitable investments for the company. They would not work in the best interest of the company. That's how it goes like, because our performance measure is not good. I told you, if we had assessed on the basis of the residual income, they would go for any investment that would add on to the ROI, and that would earn the return over the minimum return, which is the shareholder return, which is the cost of capital. So, but here, when the asset with new investment, the asset base would increase. That would decrease their ROI. That means manager performance, divisional performance is good. ROI-based assessment division. If divisional performance needs to be assessed, assessing on the basis of ROI is fine. But when you're also linking the manager's performance with ROI, that will cause dysfunctional decision making. It would rather have been done on the basis of the ROI. So ROI is more closer with shareholder. It has got more ties with shareholder value addition, and also it's good for while assessing the manager's performance, because if we're going to link their targets with ROI, both objectives will be met. Managers would be happy, okay, because they would accept any project that would just give would add on to the RI of their division. And adding on to the RI of their division would just add on to the RI of the groups, RI of the total groups as well. And that would be working in the best interest of themselves as well as for the company, which is totally in spirit with goal congruence. Okay. So last year, an investment which was expected to meet the target ROI was rejected by one of the managers because it would have reduced the divisional overall ROI. Okay, so the group target it was meeting. There was an investment that met the target. Okay, and that might have met the minimum return as well, but at the same time, it was rejected by the divisional manager because it overall reduced the divisional ROI. Okay, let's suppose there's a new investment that is earning a return of 10% and cost of capital is 10%. That means that new investment is worthwhile because it is giving you positive residual income because it's earning more than the minimum return. Okay, so it's a worthwhile investment and definitely should be accepted. But then because his ROI was dropped as a result of new investment, his ROI was dropped. His ROI was dropped to, for example, 9%, and his target ROI was probably 11%, then in that case, definitely is not going to accept this project. Why? Because he won't get bonus for that. He only get bonus if his target ROI of 11% is met. And now, after accepting this investment, his ROI goes like 9%. However, individually in isolation, that investment earns ROI of 12%, which is more than the minimum shareholder return of 10%. So it is worthwhile investment, but definitely is not going to accept it, and it will lead to a dysfunctional decision making by that manager. So here, Sportsco is considering a new performance measure, which is residual income, in order to discourage dysfunctional behavior that I've just told you here. That would be calculated using controllable profit and average divisional net profit. What we have here is net profit. I told you the three things: controllable profit, traceable profit, and net profit. Okay, so here the net profit is given. Okay, so controllable profit comes after deducting all of the controllable fixed cost as well as controllable variable cost from the sales, external, internal sales. So that gives you a controllable profit. And what comes in under the traceable profit, anything, any of the uncontrollable variable cost and uncontrollable fixed cost, but that ultimately relates to this division, it can be traced to this division, would give you your traceable profit. And then there's a head office portion cost as well that needs to be deducted in order to give you your final figure for the net profit. So three things: traceable profit, controllable profit. Yeah, definitely. I told you when managers' bonuses has to be assessed, it has to be done on the basis of controllable profit over average divisional net assets. What is going to be the formula used for the capital employed? It would be given in the question, and here you need to do it on the average basis. So we are given the opening net assets and closing net assets. We're just going to add it up and divide it by 2. Add it up, divided by 2. So so ROI, formula for ROI is going to be controllable profits divided by controllable net average, controllable average net assets here. So net assets, what about this controllable profit? Net assets, we can do that pretty easily. What about the how to calculate the controllable net assets? However, only given the net profit here, not the traceable profit, not the controllable profit. What we need for assessment is this figure, but we are given this figure. So this figure has got some uncontrollable cost deducted as well as some head office cost deducted as well. So have a look at the note below. Included in the fixed cost of this our depreciation of 165 and 460 for division C, okay, the other way around. 165 for divisions, including the fixed cost of depreciation of 165 and 460. So here it is. Including the fixed cost are depreciation of 165,000 and 460,000 for division C and E respectively. C and E respectively. So 165, including this figure, for division C and 460 for division E. 30% of this depreciation relates to assets controlled but not owned by the head office. So they are controlled by the head office. So that makes this particular cost, 30% of this cost is what? Which is uncontrollable, but it has been deducted from here. That we need to add back in order to get to which figure, in order to get to the controllable fixed cost. Okay, good enough. And what else is there? Head office cost recharges all of its costs to the division. These have been included in the fixed cost as well, and which is 620 for division A. Another cost that needs to be added back is the 620, which is the head office cost that had been deducted, and then the net profit came. So it was 620 for division C and 700 for division E. So both of these costs need to be added back in order to get the controllable profits. So let me take you, let's calculate ROI for C and E. It would be done on the basis of the controllable profits, okay, divided by controllable net average net assets. And first, doing this working, how to get controllable profit out of the net profit. So net profit, we first need to add back the uncontrollable depreciation, because assets were controlled by the head office. Okay, so their depreciation is definitely an uncontrollable cost that needs to be added back, though it is traced to this division, because the assets related to this division, it is kind of a traceable fixed cost, but yet again, it is uncontrollable because assets are controlled by the head office. Okay, head office controls assets. It doesn't own them, but it controls them. So that means the depreciation cost on those assets not controlled by these divisions is a traceable cost. It traced to this division CN, but it is an uncontrollable at the same time. So that needs to be added back. So it's going to be 165 into 0.3. So total cost. So what is the net profit figure? 1455. Okay, so we need to add by uncontrollable depreciation. For C, it's going to be 30% of 165, and for this it's going to be 30% of 460. 30% of 460, and then again we have to add back the head office cost, which is a portion head office cost. It is again not a controllable cost, and it is not a traceable cost at the same time. It is head office cost that was a portion to this division, yet again not controllable. We need to account for the controllable cost only. So we need to add back this cost as well, which is 620 and 700. So it's going to be 49.5 for C and 138 for E. And the net profit for E was 3950, and if then head office cost was added back at the same time. So here we got our controllable profits for both divisions. So here they are. And now we need to find the controllable net assets, okay? And that we controllable net assets take average of the assets at the start of the year and the assets at the end of the year. So it's going to be 13,000 plus 9,000 divided by 2, and here it's going to be 24,000 plus 30,000 divided by 2, and everything is in thousands. Okay, so it's going to be 11,000 and 27,000, and now we can calculate ROI. Controllable profit for C, it's going to be 2124.5 divided by controllable net assets, average net assets, 11,000 into 100, and same for E. Controllable profit is 4788 divided by 27,000 into 100, and the figures are 19.3% and 17.7%. If you were doing this question on Excel, so then remember, do keep at least one decimal, show your answer at least at one decimal places, so that clearly the difference between the two divisions are more clear. Okay, so now moving on to part number 2, which was the discussion part, where we needed to discuss the performance of the two divisions, and including the main reason of the performance. Okay, so which one performed better apparently? Apparently, which division performed better, which has got more ROI? So basically it was division C apparently, which performed better than division E, which has got less ROI as compared to division C. Okay, but we still have to go through. Here's a note here. Actually, division E invested 2 million in plant and machinery at the beginning of the year, which is included in the net assets. Do you know that the asset base for division E is almost how many times? If I so almost 40%. So division E has got a more asset base, definitely, and also it invested about 2 million. Okay. That would have increased the average net assets and decreased the ROI. That is the main reason. Okay. However, division C made no significant changes to the non-current assets. So its asset base is 11,000 and 27,000. So, and also that could be the reason that you need to write what is the reason, main reason for the difference. Okay, one reason is this. Okay, now which performance was better? Okay. For performance figure, you need to measure with this target ROI whether they achieve the performance or not. If I take you, where was the target? The target was 18%. So here it's achieved. But here the target was 18%. Here it's not achieved. So definitely seems like the manager for division E has been penalized for this investment. See that? He didn't discourage. He wasn't discouraged to accept. He worked. He was pretty much in spirit with the gold congruence. He didn't. Worry about not getting the bonus. Okay. Or maybe he didn't have the idea. Next time you won't do that. So definitely praising manager performance on the basis of ROI is not a good idea, because then manager will just not accept the new investment. That's what happened here. And also, there's one more thing here. The difference, the reason of the difference was also, which is included in the net assets figure, and uses and he uses the reducing balance method to depreciate assets. We know that in the reducing balance method, the depreciation in the first year, first he did new investment that decreases the ROI, and other, he is using the reducing balance method. The manager for division E is using the reducing balance method that charges a higher depreciation going to be charged for year one. Okay, and it's company's policy to charge the whole year depreciation full in advance in the year of the acquisition. And division C, which uses the straight line method. However, division C on the other hand didn't make any new investments. Okay, so that I maintained they were able to achieve the bonus and managers would be happy. But maybe they haven't accepted new investment, and they took that was the dysfunctional decision making, not working in the best interest of the company. Okay, so that it's not goal congruence here. So, and also they're not using the reducing balance method, they're using the charging a fixed cost every year over the lifetime of the asset, that is the straight line depreciation. So both of these things have decreased the profit because of a higher depreciation charge, and increased the average assets at the same time. So thereby decreasing the ROI, they fell short of the target and they didn't get any bonus. So what? Okay. For performance, just compare with the target and your work is done. Okay. How is the performance? You just measure with the benchmark set by the company, which was the target of 18%. So E didn't meet the target, how you see, but both, however, performed well. Okay, we now need to know the reasons of the difference that we had to discuss in part B. The reasons was that E made an investment, however C didn't make an investment, and that has caused him a higher depreciation charge and also decreased the profit at the same time, increased the investment, thereby decreasing the ROI. So that's the reason. We also know that ROCE is a product of operating profit margin in product into asset turnover. The operating profit margin could be the controllable profit here in this case. It's going to be controllable profit, what the managers could control, what the division could control, divided by sales, and asset turnover is sales divided by capital employed, which would be the controllable net assets in this case. So an ROC is basically the profit, controllable profit in this case, divided by capital employed. Okay, so when sales and sales get cancelled, so it's the same thing. So ROC is basically product of operating profit and net into asset turnover. So whenever on the basis of the ROCE, you want to assess the performance, how the divisions have performed, first you just did on the basis of whether they met the target return or not, target return of 18%. First on that basis, and the other you can assess on the basis of what was their profit margin as a percentage of sale, or how much sales they have generated by deploying the investment, which is basically asset turnover, which measures how many times the sales is how many times of your investment or your capital employed. So here we're going to measure these figures. So here the controllable profit, sales revenue, took from here the net assets, and let's calculate what is the operating profit margin for C&E. Then we're going to say which earns more profit as a percentage of sales and which performed better. So here Operating profit divided by sales, and here I just copy paste it and just do it like this, and just I told you to take at least to one decimal place. So here it is. So apparently, who earns more profit? It's C than E. Okay. And oh, what about the asset turnover? Definitely, uh, he has got a large base, and he also invested. He also did a new investment this year. So definitely, it would have reduced the time. The sale could be percentage of the investment. So here it's going to be sales divided by capital employed. What times? 0.3 times for this, and 0.3 times, more or less the same. And but the ROCE was yeah, taking the product of two, taking the product of the two, operating profit into net assets, and percentage, and so you got to your answer. So because of that investment, that would have increased the capital employed, but definitely it earns more profit. Okay, more profit as a percentage of sale. It earns more profit as a percentage of sales than E earns more profit as a percentage of sales than that. That clearly shows that despite the new investment, because of new investment, this figure has deteriorated. So it's basically E which is more profitable and which has performed much better than C. He didn't do investment. Okay, he saved his bonus, and he did investment, and at the same time was able to maintain the asset turnover nearly same as that of C. So overall, this reduction, he just falls short of the target. However, target was 18%. He couldn't meet that because if he just made the investment of 2 million and on the basis of the reducing balance method. So that's how you're going to discuss. Okay, but all you could discuss just by measuring the ROCE with that of the target return, and also just discussing it like this, and then concluding that which performed better despite everything. He made the investment. He has got earns more profit as a percentage of sales. He is both are good. He's also earning good. ROC is fine. Both are good, but overall E looks much better. So that's about the party. So let's continue. So now discussing the marking scheme. I told you the part A was worth 6 marks. Okay, so how you might have got? You've got 1 mark each for in order to get the controllable profit right. Okay, you've got 1 mark for that. And then you got 1 mark for the controllable so you got 1 mark for controllable profit, 1 mark for adding back this uncontrollable depreciation, 1 mark for adding back this head office cost, and 1 mark for controllable profit. That makes 1, 2, 3, 4, and 1 mark for doing this calculation of net assets. That makes 5, and 1 mark for the calculation of ROI. Okay. For example, if you got your controllable profit figure wrong, okay. So if you got your controllable, there's something known as the own figure rule, okay. Own figure rule means if you got the controllable profit figure wrong, okay, you'll be just penalized once for that, okay. And you won't marks if your controllable figure gets wrong, definitely your ROI would be wrong. But you would get the 1 mark for doing the calculation right. It won't penalize you for there because 1 mark was for controllable profit and the other mark was for ROI. If the controllable profit was wrong, using the wrong figures, definitely ROI would be wrong as well, but you would just penalize once and you would be given, though the figure for controllable profit is wrong, but you would be given the credit for calculating the ROI based upon the wrong figures. So they are not going to penalize you twice for the same mistake. They're just going to penalize you once. That's called the own figure rule, and which is pretty good. The examiner is really generous. All you have to grab those 50 marks and pass PM in the first attempt. Okay, so that's about the marking scheme. Now moving on to our third requirement. Now doing the residual income, I'm just going to do it in Excel sheet here. You need a cost of capital for that, because if they're earning, if the controllable profit is earning more than this cost of capital, which is going to be 12% of their average controllable net assets, then definitely the division would be performing well. Here the requirement is calculate the residual income for each of the division. Here you have to calculate and at the same time comment on the result of this performance measure, that how well both divisions are performing. If they are earning above this cost of capital of 12%, then definitely they would be performing well. So you don't have any target residual income. All you need to compare with the minimum shareholder return that sports company has, which is 12%. So if they are earning above this, then they are definitely doing well. So here's the controllable profit for C minus. It's going to be cost of capital is 12%, so it's going to be 0.12 of 0.12 of the investment, and here's the capital employed. So you get the residual income of 804.5. That means C is good. Okay, C was good, operating profit was good, asset turnover was fine, and ROC was above target. But just that he just might have rejected the new investment. So he didn't do any new investment just to secure his bonus. That's what he did. But definitely, that division is earning above the cost of capital of 12%. That is the minimum return, which is a good thing. As far as the residual income is a positive thing, that means it's only going to be positive if that division is performing above the cost of investment, above the cost of capital, above the minimum shareholder return. So that it automatically discourages avoids the wasteful spending. On the basis of ROI, if you make that as a performance measure, they're going to do right for the company, accept the new investments. Also, they will be aware of their cost of investment, okay, which in this case is this is the cost of the investment, okay, making them aware of the cost of the investment, okay, charging that artificial notional charge that makes them aware of their investment, and only those investments are accepted which just recovers back this minimum charge, pretend artificial notional charge, whatever you could call it. So that automatically makes them aware of their cost of the investment, and they're definitely not going to do the wasteful spending, and will make a well-informed decision which would be in the best interest of the company and their shareholders. So what about this? Here the controllable profit figure is this, minus the cost is again 0.12 into. Good thing about the residual income, maybe the cost of capital for C and E would be different. So you can definitely calculate residual income on the basis of their own cost of capital. But here the cost of capital is the same. Okay, the risk, it basically tells you the risk level, the risk in that investment. If it covers over that minimum return, okay, then that is a worthwhile, a profitable investment for the company. So its capital employed is this. So both, you see that it has got more residual income as compared to C. Okay, both are giving a positive value. That means they are earning. So here the comment is that both are performing well. But yet again, on the basis of the residual income, you are not required to compare different sizes of investment, because here the capital base for E is more as compared to, it's 11,000 as compared to 27,000. So it's not, won't be on the basis of the residual income, it won't be a like with like comparison. So definitely the one with the more asset base is for the more residual income. In order to compare it like with like, okay, and there that could be done on the basis of ROCE, and that there also we know the reason. He made an investment and he didn't, okay, and he was reducing Mellon's method, and he was using straight line, and also made no investment, so he fell short of target. It didn't get any bonus, so he pretty much secured a bonus because it made no investment. Had it made more investment, definitely it might have come down and wouldn't have got the. So the last part is explain the advantages of using residual income to measure divisional performance. That we already did that. Okay, so I told you you are required to write in the form of the paragraph, and if we're just going to go with the bullet points without explaining the reason why is it good, why is it bad, you didn't explain well the why thing or the because or all those things, and you didn't write in the form of a paragraph, you won't get marks. I told you, you would get 1 out of 4. So these are really important techniques that you need to know to pass PM paper, and same techniques you need to apply in all part of the, in all areas, in all questions you get in the exam. So residual income is linked with shareholder value because it deducts the notional charge on asset, which is the minimum return shareholder requires. So project with positive residual income shows that the project earnings is more than the cost of capital. So that's the advantage of the residual income. It ties more while creating shareholder value as compared to ROI. And RI is used to assess managers' performance because it is an absolute measure, and managers will be tempted to accept new projects that will add on to company ROI, thus will avoid the dysfunctional decision making that could be done on the basis of ROI. Because in ROI, with new investment, ROI decreases, and manager may avoid new investment if it decreases the center ROI and the bonuses on stake, which ultimately leads to goal incongruence, goal incongruent decision making, which is basically dysfunctional decision making. So that's about the advantage. And now the disadvantage: residual income cannot be used to compare different sizes investment because it is an absolute measure. It's not a relative measure that it would measure profit as a percentage of investment. So different sizes can be compared just like ROI. Because it is an absolute measure, project with higher investment are likely to have more RI than small size investment. That doesn't compare which company is more profitable, because it is not like with like comparison. So residual income is a profit-based measure, so will result in manipulation of profits by accounting conventions, policies, and estimates. Both are profit-based. The disadvantages of both are in this is going to be the same. If you're going to increase the current liabilities also, the capital employed would be decreasing. Okay, so if the assets were given in the form of liabilities, you could make that comment on that basis as well, because that reduces. Here only the opening net assets and closing net assets were given, not in detail what are the current liability, what are current assets, and what are total assets and all that. Not the breakup wasn't given. So this is how this question would earn you 20 marks. I hope you understood. That's it from today's session. Thank you very much.